wish you could just collect rent from the stock market, like just have it roll in regularly, even when things are kind of, flat.
Yeah, like clockwork.
Exactly. Well, that's the whole idea behind these, what they call high-income ETF, the ones using that covered call strategy. We're only going to dig into three of them today, IWMI, and then there's WDTE. You might remember it as IWMY. They did a whole rebrand, and then the brand new one, RDTE.
And it's smart to focus on that clockwork idea you mentioned because, yeah, these ETFs, they aim for that regular income. But anytime you see an investment promising a big payout, gotta remember there's always a trade-off somewhere. So we're going to break it all down, how they actually work, what makes each of them unique, and yeah, those potential risks before anyone goes hitting the buy button.
Right. Think of it like a shortcut to understanding this whole world of, well, honestly, kind of complex financial stuff. So to kick things off, could you give us that quick overview of covered calls? I'm sure some listeners are new to options, how they play into this whole income thing.
Absolutely. Imagine for a sec, you own some land, right? And it's got the potential to go up in value. You could sell someone the right, not the obligation, but the right to buy that land from you at a price you set on or before a certain date. That's basically a covered call option in a nutshell. The ETF's selling these contracts, and in return, they get what's called a premium. That's where the steady income comes from.
Okay, so I'm picturing it like I'm a landlord now. But like any good landlord, there's always a catch, right? What if my land, suddenly it's worth way more than that price we agreed on?
You got it. That's the trade-off. If the ETF sells that call option and boom, the asset just shoots up in value past that strike price, they might have to sell it for less than it's worth, miss out on bigger profits.
And it's like I'm giving up some potential upside to get that steady rent coming in. Classic risk versus reward.
Exactly. Now, want to add another layer to this. Remember how we talked about that date for the land sale? That's the options expiration date. Two of these ETFs, we're looking at the WDTE and the RDTE. They use what's called, get this, zero data expiration options, zero DTEs.
Zero DTE. Okay, that sounds intense. Like they're making these split-second stock market decisions.
Kind of, yeah. These options, they expire the same day they're bought or sold. So instead of collecting that land rent for a whole month or even a year, they're going for smaller payouts more often based on these tiny market moves.
So higher risk, but also maybe way higher reward.
You got it. Totally different strategy. Now let's get specific. IWMI, they're more the traditional covered call approach. They like the Russell 2000 index, which is all about those smaller U.S. companies. Anything stand out to you from their perspectives?
Well, they're actively managing things.
Yeah.
Like they're not just blindly selling these covered calls, right? They're picking stocks, changing their strategy as the market moves.
You caught that. And to make it even sweeter, at least for a little while, they've got this fee waiver happening until September 2025, which could mean even better returns for investors in the short term.
Lower fees, always a good thing. But, and I only caught this digging through the prospectus, those fees, they jump up after September 25.
That's why you got to read the fine print. Can't just look at the current expense ratio. Got to think long term. How are those fees going to change? What's that going to do to your returns down the line?
Speaking of changes, let's talk WDTE. Used to be IWMY, right? Talk about a makeover. New name, new ticker symbol, even how often they pay out is different. That's a dynamic investment.
For sure. They went all in on these zero DTE options. Daily income is the goal. Not monthly, not quarterly, daily. Totally different ball game than what IWMI is doing.
Okay, so if IWMI is like that seasoned landlord, carefully managing properties, WDTE is flipping apartments for a quick buck.
Pretty much. And their prospectus, it's all about how dynamic they are. Even says their portfolio will drift throughout the day. They're constantly adjusting to the market.
Talk about hands-on management.
No kidding. Now, last but not least, we've got RDTE, the new kid on the block.
They're all about that zero DTE life too, right? Still focused on the Russell 2000, but they call their strategy synthetic covered calls.
Fresh out the gate, September 2024. And yeah, zero DTEs on the Russell 2000, but the synthetic part is key. Instead of owning those stocks directly, they're basically simulating it, using a whole other layer of options contracts. It's complicated, but the goal is to mirror the index's performance while still pulling in that weekly income.
And they're all about that weekly payout, getting those option premiums straight to the investors.
Exactly. So we've got options expiring the same day. We've got synthetic ownership. Definitely a lot to unpack there.
Okay, so these zero DTE options, we got to dig into that a bit more. It's one thing to say they expire same day, but like, what does that actually look like in the market? Walk me through it. Pretend I'm like brand new to this.
Gotcha. Okay, so picture WDTE. Their thing is daily income, right? So they sell a call option. on a bunch of stocks, basically mimicking that Russell 2000. Let's say they think the market, it's going to stay pretty flat today, maybe even dip a little.
They're betting on sideways action.
Exactly. And for selling that option, they get their premium, say, $100, just for the example.
So they've already pocketed that 100 no matter what happens to the actual stock prices.
You got it. Now, if they're right, market chills out, maybe dips a bit, that option expires worthless. They keep the whole 100 pure profit.
Sweet deal. But hold on, what if they're wrong? Like the market goes crazy, shoots upward.
Ah, there's the catch. If the stock price, it goes above a certain point, that's the strike price, they set that when they sell the option, they might have to sell those stocks for less than they're worth now. Miss out on bigger gains.
So they're walking a tightrope here. Got to predict those tiny market moves, but also make as much as they can from those premiums.
Exactly. High risk, high reward. And that's why zero DTEs, they're not for everyone. Got to be a good guesser. Understand those intraday swings.
So it's like they're playing chess, but every move is based on what might happen in the next few hours, not the whole game.
Great analogy. And all that active management, it costs something. WDTE, RDTE, their fees are higher than IWMI. Even with that fee increase, IWMI has coming later.
Makes sense. You're paying for the expertise, basically, someone who can handle those quick market turns.
Exactly. Now, let's not forget about those risk factors we keep mentioning. It's easy to get caught up in that potential for high income, but understanding the downsides, just as important.
Right. No free lunch, as they say.
Exactly. And one risk that's front and center in all three prospectuses is cybersecurity. These ETFs, they rely on complex algorithms, lightning-fast trading. Any disruption to their systems could have huge consequences.
It's true. I mean, one successful cyber attack and that's it. Trading's disrupted, valuations are impacted, investors could lose money, and we've seen how vulnerable some of these financial institutions can be.
Absolutely. And the hackers, they're getting smarter every day. It's a risk for any investor, no matter what you're invested in.
Okay, so cybersecurity risk noted. What other red flags should we be looking for with these high-income ETFs?
Well, as we mentioned before, those yields, they look juicy, but they're not guaranteed. If the ETF strategy doesn't work, those payouts, whether they're monthly or weekly, they could shrink, could even stop completely.
Important reminder, can't treat these ETFs like a guaranteed paycheck.
Exactly. Got to think about the bigger picture, too. The market environment matters. Covered calls, they tend to do best when the market is flat or even dipping a little. Those premiums, they act like a buffer against losses.
But what about when the market really tanks?
Well, those premiums can help, but these ETFs, they're not invincible. Bear market hits, they'll probably drop too, just like anything else tied to the stock market.
No magic solution to volatility, huh?
Nope, not even close. And this is where it's important to understand each ETF's specific risk factors. IWMI, they're all about the Russell 2000. So they've got the inherent risks of small cap stocks. They can be more volatile than their large cap counterparts.
Or like speedboats than cruise ships, huh? Faster, but you feel every bump in the water.
Perfect analogy. Plus, IWMI, they're actively managing. Could be great, but also risky. Like trusting a chef with a new recipe, you never know how it's going to turn out until you taste it.
Right. It could be amazing, could be a total flop. And with WDTE and RDTE, all about those zero DTE options, those risks are even bigger, right? Since they're making such short-term bets.
Exactly. They're playing with fire, in a way. Options expiring the same day, one wrong move, and it can really hurt their returns.
And because those zero DTEs, they're so new, there's not a ton of data to go off of, right? It's kind of like sailing uncharted waters.
Pretty much. Now, none of this means these ETFs are bad investments. They can be great for the right investor, someone who wants that income, especially with yields being low everywhere else. But you got to know what you're getting into. Those downsides, they're real.
So would you say these are more for experienced investors, people who understand the risks, maybe already trade options on their own?
Probably a good call, yeah. But doesn't mean someone newer to investing should completely avoid them. Key is to do your research, really understand the risks, and maybe start small. Don't go all in right away.
Right. Don't put all your eggs in one basket, especially if you don't know what that basket's really made of.
Exactly. And that's where the prospectus comes in.
That thing, it's like the instruction manual for investing. But so many people, they just toss it aside.
Yeah, I get it. They can be a little intimidating, lots of technical jargon, but it's all important. Information about the strategy, the risks, the fees. Don't just skim the marketing stuff. Take your time, read the details.
It's like deciphering a treasure map, right? Might seem like a pain, but got to do it to find the treasure.
Exactly. And pay attention to those risk factors. Each of these ETFs, whether it's IWMI, WDTE, or RDTE, has its own quirks.
Right. And remember how we were talking about cybersecurity? That's a big one, not just some buzzword. It's a real threat. Investors need to be aware of that.
Absolutely. And one more thing, don't limit yourself to just these 3 ETFs. There are tons of high-income investments out there. Different approaches, different risks, different rewards. Take a look around, see what else is out there.
Because ultimately, the best investment is the one that you understand, that you're comfortable with, and that helps you reach your goals.
Well said.
So keep those prospectuses close. Do your homework, and remember, investing is a journey, not a sprint. Thanks for joining us on this deep dive. So for our listeners who are thinking, hey, these high-income ETFs sound kind of interesting, what are those key takeaways? What do they really need to keep in mind?
Well, first things first, got to remember, these ETFs, they're not for everyone. They're for someone who's really looking for that income, that cash flow, not necessarily trying to get rich quick. It's about that steady stream, maybe to top up other income or for retirement, that kind of thing.
Like we said, it's like collecting rent from the market.
Yeah.
But even with rentals, sometimes you got to make repairs. Sometimes they sit empty.
Exactly. No guarantees with these payouts. Things go south in the market. Those distributions could shrink, could even stop for a bit. Don't go betting the farm on those high yields staying sky high forever.
And like always, got to diversify, right? Don't put all your eggs in one basket, even if it's a shiny high-income basket.
Absolutely. Think about your own risk tolerance, your goals. Do these ETFs fit into your bigger plan? Not sure. Talk to a financial advisor. Always good advice.
Now let's talk those prospectuses again.
All right.
I know, not the most exciting read, but
Yeah.
essential.
100%. That document, it's like the instruction manual for each ETF. Don't let the jargon scare you off. Take it slow. Highlight stuff. Look up what you don't know.
It's like that treasure map we were talking about earlier. The details are the key to finding the good stuff.
Exactly. Pay close attention to those risk factors. Every ETF, whether we're talking IWMI, WDTE, RDTE, they all have their own quirks.
Right, and all that stuff about cybersecurity, that's not just a buzzword, it's a real thing. Investors got to be aware of that risk.
No doubt. And one last thought. Don't just stop at these 3. There's a whole world of high-income investments out there. Different strategies, different risks and rewards. Do some digging, see what else is out there. Find what works for you.
Because at the end of the day, it's about finding investments you understand, that you're comfortable with. That's how you reach your goals.
Couldn't have said it better myself.
So, to wrap things up, keep those prospectuses close, do your research, and remember, investing, it's a marathon, not a sprint. Thanks for joining us on this deep dive.